Hello, everybody. Welcome back. I hope everybody had a great break. And for those that just joined us, welcome. Just a repeat of some previous household measurements. Know that everybody's muted and cannot unmute themselves. And if you have any questions, please send them through the chat box. At the same time, also everybody's video has been disabled. So just trying to go to the next slide. There you go. Okay, so this afternoon's topic, the last webinar session, is certificates of tax residences, common practices and issue in the Asia Pacific regions. And we are glad that for this particular session, we have 4 panel members on board. One of them is myself as being the moderator. And from Korea, we have that is Tae-Gyung Kim, D&Co from Korea. Tae Kim is a partner in the tax practice group of Lee&Co, a leading full-service law firm in Korea. He has extensive experiences for more than 27 years in providing various international tax and transfer pricing consulting services for global companies. He is also the Secretary of the International Affairs Standing Committee of IFA Korea branch. So Ted, over to you.
We're going to have another panel member, Nilesh M. Kapadia. He is a partner of NMK & Co. LLP. He is practicing chartered accountant from India, having over 30 years experience in international taxation. He has done masters in international taxation from Vienna University and have attended meetings of committee of experts at the United Nations for several years. He is chairman of IFA India Western region. Nilesh?
Yeah, okay. Thanks for the kind words, Ted. And at the outset, I would like to thank IFA Hong Kong for giving me this opportunity of speaking at this webinar, which is a great event in the absence of the regular conference because of the pandemic. And I would take this opportunity to introduce the next speaker, who is Ichwan Sukardi from RSM Indonesia. Ichwan has a very impressive background. He is the managing partner in taxation within RSM Indonesia with more than 20 years of experience. He has provided tax advisory to a wide range of multinational and domestic companies, mostly in the energy sectors. He has also a few years experience in the oil and gas industry in Indonesia. He was with one of the large corporates engaged in the oil and gas business. And he has got a very impressive academic background. He has done Masters in International Tax from the Leiden University, Netherlands. And he is also having several other qualifications. Rather than take your time to go through each of them, I will hand over the proceedings to Ichwan so that during the course of the discussions, one can see the contribution which he has made, which is during the last couple of days, I have had good discussions with him, and his contribution to the panel is going to be very good. Very good. Over to you, Ichwan.
Thank you, Nilesh. First of all, thank you also to IFA Hong Kong for organizing this event. It is a great event, interesting topic, and also outstanding speakers. Before I pass this to Willem to comments with our discussion, I'd like to also introduce Willem. Willem is a tax partner within HKWJ firm. He has more than 25 years experience in mostly in tax planning and tax dispute, and he's based in Hong Kong. He's an expert in tax structuring, interpretation of tax treaty, and identification of tax risk. So I'll pass to you, Willem, to start the discussion.
Thank you, Ichwan. The danger of introducing each other to each other is always what is the other person saying about the other. So 25 years tax of experience also shows a little bit your age. But anyhow, the topic, as I've just said, is certificate of tax residences. We try to avoid as much as possible to focus on the country specifics. And instead of that, focus more on more common issues. However, because this is a very practical topic, it's hard to avoid to actually talk about certain country specifics. So basically, the first question we should actually, as an introduction, ask ourselves, what are tax certificates of residence, certificates of tax residence, and what is its purpose? I think in general, we just can say it's just a piece of paper stating that a particular company, for example, a Hong Kong company, is residing or established in Hong Kong for tax treaty purposes under a tax treaty between Hong Kong and the other jurisdictions, for example, mainland China. So often within that A4 piece of paper, it is also stated the types of income. Pardon, I would silence my phone. Often it also states the type of income it relates to, its fiscal period, and whether it actually can be used for more than one fiscal period, assuming, of course, that all facts and circumstances are the same. And the document is usually required by the tax authorities of the tax jurisdiction that is actually the payer, the distributor of the income. And at the same time, it's issued by the tax authorities of the tax jurisdiction that is the payee of the income. So that's the receiver of the income. So if we put that in perspective, I just have a diagram. It's a very simple diagram, but basically what you guys can see is at the bottom we have mainland China company, which is held by 4 companies in Korea, Indonesia, India, and Hong Kong. Coincidentally, our panel members are also from those jurisdictions. And then subsequently, the Dutch company on top is the ultimate shareholder of the group. And basically what happens over here, dividends are distributed from mainland China, reflecting the 35% share interest to the companies above. And then whether or not Korea, Indonesia, India, Hong Kong will distribute the income, the dividend income subsequently is irrelevant at this particular moment. But what, if we talk about tax resident certificates, what you can expect then is, of course, is that when mainland China is distributing the dividend, it will be, of course, mainland China requiring from the tax authorities in Korea, Indonesia, India, Hong Kong to produce a certificate of residence. At the same time, when Korea, Indonesia, India, and Hong Kong will distribute that income to the Netherlands, they might also require a tax residence from Dutch tax authorities to produce a certificate of residence. Although for Hong Kong, you could wonder, and we will discuss later on whether that will be the case. What we've noticed actually during our preliminary sessions we had with this panel is that actually, although all 4 countries do have the same common practices and issues, meaning we all look at at the substance of the company, and we also look at the beneficial ownership of the structure. At the same time, we can see there's a timing element that is different. Whereas when Hong Kong is actually receiving the income, at that particular time, Hong Kong is actually looking at substance and the ultimate beneficial ownership of the structure. When it's about to issue the certificate of tax residence. Korea, Indonesia, India wouldn't do that at that particular moment. They look at the later stage. They look at the stage when they're about to distribute the dividend to the Netherlands. Anyway, that's something we will also will look into a little bit later on. So if we go to the first question, which is a little bit a country-specific question. The question is in general, what are the requirements of your tax jurisdiction to issue a certificate of tax residence? So we, all panel members will briefly discuss what is required in their jurisdiction to obtain such certificate. So maybe Ted, you can go first.
You are on mute. That.
In Korea, in order to obtain a certificate of tax residence, taxpayer needs to complete a simple application form, only one page. The application form requires the information of transaction parties, including the Korean payer and foreign recipient, and the target year and the purpose of applying for certificate of tax residence, including treaty tax rate and the application of tax treaty or other purposes. Brief detail of income and foreign tax to be paid information, will be provided. Those supporting documents would be required when applying for certificate of tax residence. In case of a company incorporated in Korea and they registered for tax purpose, I think that there would be no problem in obtaining the certificate of tax residence in Korea.
Ichwan?
Yeah, in Indonesia, assuming that there is a dividend income coming from China in this case, and Indonesia is required to prove that the recipient is Indonesian resident. For tax purpose, it is not an issue. There is a regulation issued in 2018. So basically, the Indonesian Tax Authority, or we call it Director General of Taxes, can issue this certificate of resident as long as the Indonesian taxpayer qualifies of some requirements, such as it is Indonesian taxpayer. It has a tax ID in Indonesia, and the latest tax season has been submitted. So if for example, if it is in relation to, say, 2020 fiscal year, and then you have to demonstrate that the relevant fiscal year tax return has been submitted, and of course, if any tax payable, and those have been fully settled. And also there are some administrative requirements, such as that one letter can only be issued for one, country, and also there must be sufficient information of the requester, in this case the Chinese company. And also in relation to the letter itself, it can be submitted or requested through online application. So then the system will ask you to provide the relevant information, and then it can be easily downloaded once all the requirements are met. As simple as it is, Willem.
Nilesh?
Yeah, Willem. If I was to look at the tax residence certificate, it is like a passport to enter a tax treaty to get any benefit. And like any passport, one has to make an application using an application form. And that is what happens in India. Till 2013, there was no specific rules or forms laid down for this purpose. And one had to approach the assessing officer and request him. And in most cases, he did grant the certificate of residence if you were being assessed as a resident. But after 2013, this process has been codified, and there is a form prescribed for the purpose of making the application and for the officer to issue the certificate. Currently, the process is offline, but I'm told that this process is going to be made online very soon. And at the time of issue of the certificate, we have to mention certain basic details like your tax identification number and the reason for which you are asking the certificate. The certificate does not mention any specific country for which it is issued. So if you obtain a certificate for a transaction with China and you tomorrow have a transaction with Indonesia, you can use the same certificate. And only one certificate is issued. So if your the payer or your other part, the counterparty requires another certificate, you can provide a notarized copy rather than request for an additional certificate, because the authorities issue only one original. I think that's all from my side.
Thank you, Nilesh. So hearing what India, Korea, and Indonesia are doing, it seems to me it is all quite easy to obtain such, or relatively easy to obtain such certificate of tax residence. I think in Korea, that told me during our pre-session, if you want to have at least 1,000 copies, you can get that. What happens in Indonesia is something I think it's also quite interesting, because in Indonesia they said, well, you're able to get such certificate of tax residence, but make sure first you have paid all your duties, have paid all your taxes. I think it's Hong Kong and probably also in Singapore where usually the trouble starts when you apply for a certificate of tax residence, because although the form itself is just only 4 pages, in practice you will submit with those 4 pages in which questions are being raised about substance. In practice you will add to those forms a appendix. Because simply the form doesn't give you enough room to write all your substance elements down, but often the letter is accompanied with appendixes stating actually in detail or actually providing actually additional information. In practice, you will get more like subsequent, after you submitted the application, you will get follow-up questions. And the IRD will, the Hong Kong Inland Revenue Department, will really look into the substance and the beneficial ownership of the company. And what we see is that often you end up with actually a lot of correspondence resulting in a very thick binder. And if you compare that with Indonesia, Korea, and India, it's amazing how challenging it is actually in Hong Kong to obtain such certificate of residence. Obviously, the main reason for that is, of course, when you distribute the income out of Hong Kong, we don't have that many withholding taxes, so then we would not raise any questions. But if you look at the domestic law of Hong Kong, it should be quite simple. As soon as the company is incorporated in Hong Kong, if you are able to show a business registration certificate, you should just get a certificate of incorporation, or sorry, a certificate of tax residence, as is the case in Indonesia, Korea, and India. But somehow, because the Hong Kong tax authorities want to be a good treaty partner, they cause more trouble. Moving on to the next question. Let's see if I can move the slide. Yeah. And maybe this is more an issue that raises in Hong Kong, but I think Nilesh also want to say something about it. But the question that we raise here is actually, should a tax authority actually be forced to issue a certificate of tax residence? And if not, should one be at least able to formally object against a decision not to issue such a certificate? So maybe Nilesh, you want to say something about this?
See, as I mentioned, now the process is reasonably codified. Earlier, there was it was discretionary. You approach the tax officer, and he may grant, he may not grant, and it was an offline process. So there could be instances of corruption. but now the process is entirely codified, and it is means once the application is submitted, it is expected that the officer will take a decision on that. If you are a company incorporated in India, there is no reason why the certificate should not be granted. If you are claiming that you are a resident of India because you are having a place of effective management in India, maybe you will need to give some documents to support that. But otherwise, that certificate is generally issued. The question of forcing anybody, I am not aware of any case in India. But if it is not issued on a specific case, there is no provision to formally object or go into appeal against such a decision. One may request the higher authorities on an administrative basis, but not on the appellate side.
Ted?
Yep. In Korea, in principle, under the Korean tax law, issuance of certificate of residence would be discretionary. However, Korean tax authorities are required to issue certificate of residence once they receive an application having information requested under the presidential decree. In case of individual, there may be a comparatively complicated situation of determining the residency, but in case of domestic companies incorporated in Korea, I don't see any problem in issuing the certificate of residence. If Korean tax authorities do not issue a certificate of residence, taxpayer, I think, should be able to submit the complaint officially.
I think we should, in Hong Kong, we should learn, I think, from India somehow, because it was raised in Hong Kong many times whether or not we could actually, when there was actually a negative decision against the issuance of a certificate of tax resident, whether we could actually object against it, right? Whether we actually could have a kind of judicial review of that particular decision. But during meetings between the Hong Kong Inland Revenue Department and the tax practitioners, it was said that, well, because the COR issuance is there are no statutory provisions for that, you cannot JR against it. I think the only thing we could do is ask for a review by what we call the chief assessor of the tax treaty section. But the problem of that is, of course, it's still part of the Inland Revenue Department. So at the end of the day, it doesn't really make much difference. And I assume that most of the times the chief assessor would do the same thing as his colleague, and once denied, keep it denied. So as such, I think Hong Kong maybe should learn from India, where something that was not codified before has been codified now. Moving on to a next question. That's question 3. And here the question is whether the tax authorities should issue actually a certificate of tax residence for other purposes than tax, or for taxes not covered under the relevant tax treaty. Maybe that can shine his light on this. Ted, do you want to say anything about this?
Sorry. A Korean application form for certificate of residence includes a column for the taxpayer to check the other purpose than tax treaty purpose. So based on that certificate of residence application form, I think Korean tax authorities would issue certificate of residence for the purposes of other than tax, or for the purpose of taxes not covered under the relevant tax treaty. However, the COR would be issued in the same format. So I don't think that Korean tax authority would consider the economic substance when issuing the COR. You're mute.
Ichwan, maybe do you want to comment?
Yeah, the practice in Indonesia based on the regulation, the tax authority issues a certificate of domicile. It is for the purpose of a tax treaty application. So that is the rules in practice. But I've never had any experience dealing with the situation where we have to obtain COR for the purpose of taxes not covered by the treaty. But I would expect that if you demonstrate that you were a resident of Indonesia for tax purpose, it is registered in Indonesia, and then the taxpayer should be able to say obtain such letter as well. But of course, the format will be rather different, because the one that you can obtain online is basically covers only for tax treaty purpose.
The reason why we mentioned this is because if you look, for example, at we in Hong Kong deal sometimes with listed BVI companies that are managed and controlled in Hong Kong, and they need to declare themselves actually as being tax resident in Hong Kong to avoid actually those BVI economic substance rules. And when you ask the tax authorities in Hong Kong whether they would be willing to actually issue such certificate of tax residence for the Hong Kong company for actually economic substance BVI rules purposes, they are quite reluctant in doing so. The same applies for sometimes companies would request the Hong Kong company or from the tax authorities in Hong Kong whether or not the company in Hong Kong is actually VAT exempt. That as well is often not being entertained by the tax authorities in Hong Kong. Other question mark that actually relates a little bit to certain circumstances where maybe certain taxes, withholding taxes, are not really covered under the tax treaty. An example, for example, is whereby a Russian company pays to the Hong Kong company certain service fees for shipping arrangements. And in Russia, there is a domestic tax that actually states that if you actually distribute those type of fees to Hong Kong, there's a 10% withholding tax unless you can show a Hong Kong certificate of tax residence. And the question is actually whether that is being entertained in Hong Kong. We had a case where it was actually accepted by the IRD and Hong Kong Inland Revenue Department. And so you could argue that in particular circumstances that the Inland Revenue Department is still willing to entertain certain certificate of tax residence, even when the tax is not covered or partly covered under the tax treaty arrangement. Moving on to following question, that is question 4. As we just said before during the introduction, is that most tax jurisdictions, right, they look at the tax substance and they look at beneficial ownerships. But as I said before, the checks might be different. In Hong Kong, this normally takes place when the income is being received or about to be received, and you need to show get a certificate of tax residence from the tax authority in Hong Kong. But in Korea, India, and Indonesia, this is a later moment. But in both circumstances, or in all circumstances, all countries are looking at the substance of the company. And the general question that I would like to put forward here to the panel is whether we would not be better off with just having fixed substance rules in place. I mean, it is either that the tax authorities will look into do a kind of balancing of exercise, whether your company has enough substance in Hong Kong, or we have fixed rules, such as that when you have two local directors on board, the local directors do have a particular type of income. Maybe they both earn 100,000 euro a year. There's a particular office. These are when you've met those conditions, you have substance, right? Certain countries like the Netherlands, I think maybe also Singapore, when you have these rules in place, it is considered to have enough tax substance, and you don't need to do really a balancing of exercise. What is Nilesh? What are you thinking about that?
Yeah. Thanks, Willem. See, if there are two views possible, perhaps India will have three views, because we have got no fixed rules on substance in India, but we have got other parameters in different specific treaties. For instance, India-Singapore Treaty has a minimum threshold of expenses which need to be incurred by a Singapore company in order to get benefits under the India-Singapore Treaty. And vice versa, if the benefit is to be given by the Singapore entity, by the Singapore government, they also have a threshold that the Indian entity must have certain minimum expenses. And so far as Mauritius is concerned, there is a very old circular of 2000, which was not on substance but on beneficial ownership, because there was a lot of litigation about entitlement to treaty benefits between India and Mauritius. In 2000, a circular was issued by the Central Board of Direct Taxes, which said that if the Mauritian company provides a tax resident certificate, it shall be deemed that it is also the beneficial owner of the underlying income. This was a very surprising circular, and it was challenged by several social organizations in India, and matter went to the Supreme Court, and after many years, the Supreme Court has upheld the validity of that circular. But other than that, there are no substance rules or fixed substance rules in India. So Mauritius and Singapore, yes, there are certain precedents, but other than that, it will be always fact specific, the activity of the company, the number of employees, the type of income, and so on.
So Nilesh, you say for the tax treaty between India and Singapore, but also India and Mauritius, there are certain substance rules, fixed substance rules in place?
No, it is the beneficial ownership circular that if you have a tax resident certificate from Mauritian tax authorities, you are also deemed to be the beneficial owner of that income. Now, actually, being a tax resident and being the beneficial owner of that income are two separate things. But in 2000, the Central Board of Direct Taxes said that if you are a tax resident, you are also the beneficial owner. This was the surprising circular which came in 2000.
Right, but then, okay, but then we talk more about the Indian-Singapore tax treaty, which actually says if you have a particular expense,
yes,
then you are supposed to have substance.
There is a limitation of benefits clause that the treaty will not apply unless you have certain minimum expenditure. So it is not a substance rule, but it is a LOB clause in the treaty. And
what is the reason that India has particular special treatments with Singapore and Mauritius?
Mauritius, India has got a historical relationship with Mauritius. Even today, I am told that 40% of the population in Mauritius is of Indian origin. So historically, these benefits were given to Mauritius, and somehow Singapore has also done a tug of war with the authorities that if you are giving a benefit to Mauritius, why not to Singapore? So the treaties were renegotiated and protocols were inserted in the last few years to give Singapore almost the same benefits as are available to Mauritius.
All right. Maybe Korea, do you want to say something about it? Ted? That you're you're muted.
There have been a lot of disputes with respect to beneficial ownership in case of application of a tax treaty in Korea. Actually, we have been struggling with the beneficial ownership issues involving Cayman Island limited partnership for a long time. Beneficial ownership issues are mostly raised in case of Korean sourcing compared to overseas. The court's decisions were different case by case. It was very difficult to determine who the beneficial owner is with respect in compared to overseas. There have been predictability issues. So as you indicated in the question 4, it would be better to have fixed substance rules in place in Korean tax law, even if it may be difficult for Korean tax authority to accept. Korean tax authorities may consider that substance rules cannot be fixed. That's the problem.
Ichwan?
Okay, thank you. In Indonesia case, it is more relevant to if Indonesia in the acting as the payer of the income. So it is in relation to payment of dividend interest or royalty to or interest to Netherlands in this case. So we do have a specific form called Form DGT. So it basically the requirement for any non-resident claiming treaty benefit with Indonesia. So Indonesia is as the payer of the income. So based on the Indonesian income tax rules, any payments to non-resident is subject to 20% withholding tax. So if you need to say obtain treaty benefit, either reduction or exemption in this situation, so you need to fill in this form. The non-resident is required to provide this to the Indonesian payer in order for them to say apply whatever rate or exemption mentioned in the relevant treaty. So, and in relation to the substance, there is specific part of the Form DGT that the non-resident must declare that it qualifies or it meets the substance requirement. So there are some questions that you need to answer, that you need to provide answer with yes, otherwise then the substance will be questions, and then the Indonesian tax authority will reject the application. So the relevant questions include economic substance, legal form, then the entity must have independent management, assets, the employee, etc. Those must be declared. So it is a self-assessment. By say fulfilling this requirement, which is included in the form, then it is satisfied at the moment. But the Indonesian tax authority may challenge later on if they find or they receive any other information, the fact that it is different what is stated in the form. Okay, that's from Indonesian perspective, Willem.
Yeah, thank you all. I think it's indeed interesting. I think at the end of the day, it really depends on how much weight, of course, the local Inland Revenue Department, tax authority is actually given to the day-to-day management activities. Because at the end of the day, you could always argue that the effective management of a subsidiary or any subsidiaries comes from the company at the top, right? The share of the ultimate shareholder. So it's all about like how realistic the tax authorities is willing to how it's willing to accept your case that there's enough daily management activities taking place in your particular jurisdiction. Moving on to the next question. Let's see. Right, that's question 5. When a certificate of tax residence is issued, the question is whether your tax authorities would also look into whether the company is actually beneficially entitled to the income. And that is particularly the case in Hong Kong. Whereas in the other three jurisdictions we're talking about right now, Korea, India, and Indonesia, the beneficial owner check takes place upon distribution of the income. Maybe Nilesh and Ichwan and also Ted can just in brief, not too much in detail, shine light on your local requirements.
Yeah, thanks. I'll mention about the requirements in India. In India, the check for beneficial ownership is done at the time of remittance of income. And at that time, the remitter is expected to obtain a certificate from a chartered accountant certifying the amount of tax to be withheld. At that time, the chartered accountant will go through your treaty entitlement, and therefore he will also have a look at the beneficial ownership and he will issue a certificate. Thereafter, the matter will be taken up during the tax audit by the tax department, maybe 2 or 3 years later down the line. And if they find that the certificate or the remittance was made without the considering certain aspects, or that the treaty benefits were not supposed to be given, they will raise a demand on the person who has made the remittance, because they will treat him as an SSA in default, the person who has not withheld the tax as per the law, and then the litigation will start. This is how the process works in India. Thanks, Willem.
Ichwan?
Yes, the Indonesian practice, I think I mentioned briefly on the substance requirement. So the same form contains also the requirement to justify that the recipient of income is beneficial owner. So you need to basically confirm and provide some answer to the questions whether the recipient is acting as agent, nominee, or conduit. It has control to use or to enjoy the funds or the income received. Not more than 50% of the income is used to fulfill the other obligations. So those are basically consistent with the OECD requirement. But there is one interesting case where the Indonesian Tax Authority challenged the even though the non-resident has sufficiently provided this form and with all sufficient responses, but they challenged on the use of the bonds or double-decker structure under Indonesia-Netherlands Treaty, because it is more on the fact that based on 2002 tax treaty Indonesia and the Netherlands, the withholding tax on interest payments is agreed at 0% if tenor is for more than 2 years. So my understanding, it appears that the Indonesian tax authority is not happy, so they challenge the fact that the recipient, according to their opinion, it does not satisfy as being the beneficial owner. So that 0% is denied and 20% was imposed. And then the case itself, most of them, they are now brought to the Supreme Court. I think that's the update from Indonesia.
Yeah. In Korea, when issuing a COR, Korean tax authorities would not check whether Korean company is beneficial owner of income received from overseas. I think it is because every income received by Korean company from overseas should be subject to Korean income tax in Korea. However, when paying Korean source income to overseas, whether the recipient of income is beneficial owner of the income should be reviewed. Beneficial owner should prepare and submit the self-declaration form for reduce the tax rate or full tax exemption under the tax treaty to the withholding tax agent or tax authorities. Beneficial owners should also prepare and submit the application form form for tax exemption under the tax treaty to Korean tax authorities through withholding agent by attaching COL. Requirements for the beneficial ownership are not defined in Korean tax law. Under the court's decision in determining who the beneficial owner is, various and complicated substance should be considered, including whether the income recipient maintains physical presence in the treaty country, or whether the income recipient has the independent disposal right to the income paid by the Korean entity, or whether the income recipient is subject to tax in the resident country, something like that. In case of overseas investment vehicle, we call it YV. Different rule applies in terms of determining who the beneficial owner will be.
Thank you, Ted. I won't go into detail with the requirements actually in Hong Kong, but the annoying thing, or what I think is incorrect in Hong Kong, is that when there's a distribution takes place, and looking at our previous diagram, if there's a distribution from mainland China takes place to Hong Kong, and the tax authorities in mainland China require the Hong Kong tax authorities to issue the certificate of residence. When you make the application and reply to questions from the Inland Revenue Department, the IRD actually is looking at the beneficial ownership, and often, or quite all the time, I think that's the wrong question to ask, right? Because what happens then is that the tax authorities of Hong Kong are sitting actually on the chair of the mainland China tax authorities. I think the question of beneficial ownership in such a particular case can actually only be decided by the mainland China tax authorities. I don't think the Hong Kong tax authorities are qualified to answer that question, and neither that they're actually capable in doing so, because they need to actually, well, you could say, study the local laws. And how can you, as a foreign tax authority, decide for on behalf of the mainland China tax authorities whether or not there is beneficial ownership? I don't think that is a question that should be raised by the Hong Kong tax authorities in general. Just focus on substance, that should be sufficient. Moving on to another question. Question 6, the OECD, they introduced the beneficial ownership rules, concepts actually, to avoid treaty shopping. And the question is, have you actually come across cases where there was no treaty shopping involved, but where the tax authorities still refused to lower the withholding tax rates, or in the case of Hong Kong, refused the issuance of a certificate of tax residence? Ted, I think you were saying there are a lot of cases about that in Korea.
Sure. In Korea, there have been a lot of disputes in relation to beneficial ownership issues. Whether those cases involved treaty shopping or not itself was also very controversial. Korean tax authorities have challenged a normal holding company structure or normal fund structures involving collective investment vehicles or overseas investment vehicles. There have been various court cases. In previous court cases, Cayman Islands Limited Partnership was treated as a beneficial owner, even though it was not subject to tax in the Cayman Islands. And under the court ruling, no treaty benefit was allowed to the fund structure. According to recent revision of tax law, beneficial ownership issue fund structure involving OIV, overseas investment vehicles, appears to be resolved.
Nilesh?
Willem, I don't know of any case where the parties agree that there was treaty shopping. That is something which everybody says, everybody does, but everybody says that we don't do treaty shopping. And beneficial ownership, there has been a very interesting case in India with respect to, again, the Mauritius Treaty. There was this NatWest Bank of UK, which had invested in India via Mauritius. And they went for a ruling that they will be entitled to the India-Mauritius tax treaty. And therefore, they should not be taxed on the capital gains, and the dividend and interest income should be taxed at a lower rate. In looking at the facts of the case, the authority has ruled that the Mauritius company was not the beneficial owner, and therefore the India-Mauritius treaty benefits should not be allowed. But again, there is one interesting aspect. They went through the India-Mauritius treaty article on capital gains, and the article on capital gains does not require, it is not qualifying by beneficial ownership condition, and therefore they held that so far as income by way of capital gains is concerned, the India-Mauritius treaty will apply, but for dividend income, it will not apply. And there have been several other cases also on beneficial ownership and therefore the treaty entitlement. But coming to your question, that where no treaty shopping was involved, I'm not aware that anybody says that yes, treaty shopping was involved. So, but where treaty shopping was there, there has been disputes regarding beneficial ownership, and some in favor of the taxpayer, some against the taxpayer. Thanks.
Ichwan, any comments?
Yeah, it is the case that the one that I shared earlier. So basically, the Indonesian tax authority consider that the use of Netherlands subsidiary to say obtain lower. No, this is basically to say get the access to funding from European. So it is considered as tax-driven motive. So it does not specifically say it is treaty shopping, but on that basis, because the most of Indonesian tax treaty on the withholding tax rate on interest payments is either 10% or 15%, but the one in the Netherlands is quite unique, 10%. So on that basis, they consider that it is as tax-driven motive, and then argue that if the recipient is not considered as beneficial owner, and then the treaty rate was denied. I think that's supposed part of the treaty shopping as well.
Thank you, Ichwan. Yeah, my point here is actually that I think we talk about, for example, the same treaty benefit rule. Often, what I've noticed a couple of times when you do an application for a certificate of residence, sometimes the IRD is a little bit too much focused on the beneficial owner concept, and not realizing that if the company was held directly by that particular entity, ultimate beneficial owner, the rates would be the same. And so, because you could argue, if there's no treaty shopping, there's no benefit of having a treaty in between, there should that company should also be actually a beneficial owner. Moving on to a next question. Oh, we in the interest of time, we need to maybe speed up a little bit. Question 7 is whether the non-discrimination articles of tax treaties also can assist us with actually obtaining a certificate of tax residence or a lower withholding tax rate. Nilesh, do you want to say something about it?
Yeah, very briefly, there have been cases that the non-discrimination article has been invoked and a treaty benefit which was denied has been made available because the lower withholding rate or the narrower scope of income has been applied using the non-discrimination article. There have been a few cases, and the non-discrimination article has been successfully applied in a few cases.
Okay, Ted, I think you want to say something about it as well?
Briefly, substance reform rule and beneficial ownership rule in Korea have been evolved as a general anti-avoidance rule from domestic substance over form rule in Korea. So generally, non-discrimination articles of tax treaties would not be helpful in Korea, with obtaining a lower withholding tax rate under a tax treaty. But in previous case, Korean court denied the treaty benefit to the ultimate investors having treaty. So in that situation, taxpayers has been arguing that treaty benefit should be allowed based on the ultimate investors' residency in substance.
Thank you, Ted. I think Ichwan, you didn't want to say anything about it, right? Or
yeah, no. Technically, yes, it is possible, but I've never had any experience dealing with this situation.
Right. Okay. Well, we in Hong Kong, we use this sometimes as an additional reason to actually, of course, acquire successfully the certificate of tax residence. But you always can try. Maybe one of the last questions I would like to raise, maybe we skip question 9, but question 8 might be of interest. And the question is whether you have encountered any mismatches and how that was actually being solved. So the question is actually like, if you have a certificate of tax residence that is valid for the year 2020, but then a dividend will be paid out in the year 2021, but it relates to the year 2020. Will your tax authorities still accept that? Each one?
Yeah, they back to the use of the form DGT, in this case, in the situation where Indonesia is the payer of the income. So the form requires the non-resident to say ask the relevant competent authority to provide approval or acknowledgement to this specific form. But I understand some jurisdiction is reluctant to say certify this form. So then the Indonesian Tax Authority accept also the a certificate of residence. So the form itself, suppose if it is certified by the tax authority, it can be used, or it valids for 1 year since the date of the issuance. But if say it is supplemented with the say official certificate of residence, then there may be an issue if the relevant certificate of residence mentions specific fiscal year. So, for example, it is for the use of current period, but the certificate of residence mentioned that it is resident for fiscal year, say 2020. So it is passed already. So what we need is the current one. So in this case, the treaty benefit will be denied, but it does not say that you cannot claim. You can, the non-resident can claim later on once the newer certificate of residence is applicable. Okay, that's from Indonesian point of view.
Nilesh, any comments you want to add?
Very briefly, as I mentioned earlier, the certificate of residence is considered by the chartered accountant when he's certifying the payment and the rate of tax under the treaty. At that time, he will look at the overall facts and circumstances, like whether there was tax residence in the earlier years, whether there are any change in the facts and circumstances, and he may allow a remittance based on that. When the tax audit takes place after 2 or 3 years, obviously the certificate of residence would have been obtained by the remitter, and at that time, if it is not available, there could be an issue. But otherwise, if it is available, there is no issue. Thanks.
Ted, do you want to say anything?
There may be mismatching issues in Korea, but in practice, I have not encountered any issues of mismatching with respect to this validity period of the COR and the payment of income itself, because the COR would not be necessary in order to be eligible for treaty benefit. I mean the reduced tax rate. In getting the reduced tax rate, we don't need that. We don't need the COR. Only if the foreign taxpayer, foreign company wants to get the full tax exemption, I mean non-taxation under the tax treaty, in that case, COR would be required to be submitted. So generally, the foreign resident, foreign company would not need to submit the COR in obtaining the reduced tax rate. And in relation to the the case, so the foreign company submitting the COR, interestingly, there's no specific regulation in terms of the validity period of the certificate of tax resident under the Korean tax law. Maybe in the case of the COR is too old, the old COR may be issues, but we don't have that specific rule in limiting the validity period of the certificate of tax residence. So we think that the old COR could be submitted to Korean tax authorities, and later the Korean tax authorities may request new one, and later during the tax audit, maybe the taxpayer should be able to submit newly issued COR at the time.
Yeah, thank you, Ted. I think in Hong Kong we should just need to produce a new tax resident certificate, whether we like it or not. So, and then of course all the questions start again, right? The beneficial ownership and substance questions. So for us in Hong Kong, it's always quite a hassle. Question 9. Yeah, it's in the interest of time. I won't discuss it maybe in detail with the panel members, but the whole thinking is that like we in Hong Kong often, when we deal, for example, with Indonesia, we sometimes have Hong Kong companies that have clients in Indonesia, and when the Indonesian companies or actually clients pay certain service fee to Hong Kong, each time in Hong Kong, we would actually need to provide for a new tax resident certificate. And in Hong Kong, it seems that, but the fact that the tax authority is quite reluctant in issuing more than one tax certificate. But I'm pleased to know that Indonesia, but also India, is a bit flexible there, such that they would also accept notarized copies of those tax resident certificates. Well, that actually also concludes our presentation. I think the general conclusion is that substance and beneficial ownership rules apply in all our jurisdictions. However, the timing element is different. It seems though that obtaining a tax certificate in Korea, India, and Indonesia is relatively easy compared to Hong Kong. But of course, there's a trouble in those Indonesia, Korea, and India starts when you're about to distribute the income. So this concludes actually our tax webinar. Thank you, panel, for joining, and also thank you all participants for joining. Just one note, this coming Thursday, there's another webinar, and the two topics are indirect transfer taxes and exchange of information. Indirect transfer taxes, the moderator for that panel is Stefano. Mariani from Beacon. And for exchange of information, it will be Michael Orliski's from Baker McKenzie role to moderate that particular panel. So I hope also that everybody received the Zoom details for that particular event. If not, please let us know. So I hope to see everybody soon again, and obviously, hopefully, see you guys at this coming Thursday. So thank you for joining.